Welcome to the cheat sheet that could save your restaurant thousands. You know food. That's your passion and your business. But how confident are you about the web of taxes that apply to every plate you serve? Understanding how restaurant food is taxed isn't just a task for your accountant, it's a vital profit protection strategy. Here's the big picture: there isn't one tax on restaurant food. Instead, you face a layered system: federal income and payroll taxes shaping your profits, state sales taxes almost always hitting prepared food, local add ons in many cities, and special levies like meal, beverage, and tourism taxes. Different menu items can be treated differently, even on the same ticket. By the end of this breakdown, you'll see how to forecast rates, price confidently, and protect your margins. With the table set, let's dig into why this question matters so much to operators like you. Here's the million-dollar question: how is every bite you sell taxed, and which levers can you legally pull to keep more of each dollar? This isn't just accounting jargon, it's survival strategy. Because in cities like Chicago, Minneapolis, and Virginia Beach, combined tax rates on restaurant meals can exceed 11%. That's not a typo. 11% of every transaction vanishes before you see a dime. Across thousands of sales, that difference decides whether you expand to a second location or close your doors. Prepared food is almost always taxable, while grocery-style retail items may be exempt. Hot versus cold can flip a tax switch entirely. And starting in 2026, a new charitable deduction floor may erase the benefit of some food donations. If this question guards your margin, the answer starts with understanding what most operators are getting dangerously wrong. Let's go there next. So, where do most operators stumble? They look for a single, simple tax rate to apply everywhere. But that's a recipe for disaster. They assume dine-in, takeout, hot food, and cold food are all taxed identically. Yet those distinctions often decide what's taxable in the first place. They blend grocery-style retail with prepared foods and miss valuable exemptions. They plan food donations expecting a deduction, not realizing the 1% charitable floor kicking in for 2026 can eliminate those benefits entirely. Multi-unit teams recycle last year's filing patterns and trip over new rates, rules, and deadlines. And documentation for business meals, date, attendees, purpose, amount, goes missing, shrinking deductions at exactly the wrong time. The gap between simple thinking and complex reality is where profits disappear. You can't memorize one number because you're dealing with a constantly shifting, layered system that stacks federal, state, local, and special taxes on every single transaction. The good news? There's a systematic way through it. So what's the solution? A systematic, layered tax playbook that transforms complexity into routine. First, a layer audit. Map your state rate, then stack local add-ons and any special levies, meal, beverage, or tourism taxes. Remember, 45 states impose statewide sales tax. 5 do not, and Alaska still allows local taxes, so you're never completely off the hook. Second, build an item taxonomy. Separate prepared food, heated, combined, or sold with utensils, from grocery-style retail items. Third, price and forecast cash flow using effective rates by item and location, so remittances never catch you off guard. Fourth, lock a compliance cadence for each location: who files what, where, and when. And fifth, set a clear deduction policy. Business meals remain generally 50% deductible with documentation, and you need to model the 2026 1% charitable floor for any food donation programs. This blueprint transforms confusion into control. Now let's look at the data that makes this real. Now for the breakthrough findings that will reshape your strategy. State sales tax on prepared food typically ranges from 2.9% in Colorado to 7.25% in California. 5 states have no statewide sales tax: Alaska, Delaware, Montana, New Hampshire, and Oregon. But Alaska still permits local taxes, so you're never completely off the hook. Cities in 38 states can stack local rates, pushing combined meal taxes dramatically higher. Chicago can reach 11.75% in some downtown areas due to the MPEA surcharge. Minneapolis can hit 12.03%. Virginia Beach reaches about 11.5% with its meal tax. Tourism hubs like New Orleans layer multiple levies simultaneously. Here's the critical distinction: prepared and heated food is almost always taxable, while unprepared grocery items may be exempt. In New York, a plain dozen bagels to go isn't taxed, but toast one bagel with cream cheese and boom, it's taxable. And here's the kicker for 2026. The 1% charitable deduction floor could eliminate tax benefits for donating surplus food unless your contributions exceed 1% of your taxable income. Most restaurants are pass-through entities and may benefit from the qualified business income deduction. Business meals generally remain 50% deductible with proper records. So, how do you turn all of this into real profit protection? Let's translate findings into moves. So, how do you apply these findings to protect your margins? Start with menu engineering powered by tax intelligence. Your best sellers generate the most tax liability. If your signature dish accounts for 30% of sales in an 11% tax jurisdiction, that's a massive cash flow obligation you're remitting constantly. By understanding which items carry higher tax burdens, you can strategically bundle products or offer certain items in retail packaging to shift their tax treatment. When scouting locations for expansion, that 4% tax difference between jurisdictions directly impacts your competitive pricing and profit margins. Bake it into every site selection decision. Multi-unit operators face complex filing requirements. Some states demand consolidated returns, others want separate filings per location. Miss these details and penalties devour your expansion profits. And maximize your deductions within the rules. Keep bulletproof business meal records, plan company-wide events where appropriate, and model whether your donation program will still clear the 1% charitable floor starting in 2026. With the moves mapped out, let's zoom out and see the bigger shift this enables. This is where everything shifts. Stop treating tax as a year-end headache and start using it as a strategic lever, your competitive edge. Standardize how your point-of-sale system flags items, heated, combined, utensils provided, sealed retail, so taxes calculate correctly on every transaction. Maintain a live rate matrix by location, including all special levies, and wire that directly into your pricing and cash flow forecasts. Build a compliance calendar with clear owners for every return, and automate accruals so remittances never surprise you. Keep a deduction dashboard. Business meals at 50% with complete documentation, 100% for limited cases like company-wide events or food given free to the public, and a forward view on the 2026 charitable floor and employer convenience meal changes. Track emerging legislation, sales tax holidays, new beverage taxes, tourism levy changes. The operators who succeed long-term are the ones who embed tax intelligence into every decision, from recipe development to real estate. The complexity isn't going away, but your confusion can. Let's lock this all in with a clear action plan. Let's bring it all home with a simple 30-day plan you can actually run. Week 1. Audit your layers by location and tag your POS items as prepared or retail, hot or cold, utensils or not. Week 2. Forecast the effective rate for your best sellers. Adjust prices if needed, and set cash flow accruals so remittances never sting. Week 3. Lock in compliance deadlines for every site, tighten your business meal documentation, and model your donation program against the 2026 1% charitable floor. Week 4. Fold tax rates and site selection decisions and train your team on the hot versus cold and utensils rules, then sync your full playbook with your CPA. Here's the quick recap. Restaurant food faces layered taxation: federal income, state sales, local additions, and special levies that can push combined rates past 11%. Prepared food is almost always taxable, while unprepared, grocery-style retail may be exempt. Hot versus cold and utensils provided can flip tax status entirely. Business meals remain 50% deductible with proper documentation, and the 2026 charitable deduction floor and employer convenience meal changes are coming whether you're ready or not. The operators who master this maze don't just survive, they thrive. Tax strategy isn't just compliance, it's profit protection baked into every decision you make. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.